Hello everyone, welcome back. In the previous session, we completed security analysis chapter and securitization. Now we'll be starting with risk management chapter. Risk management. Types of risk faced by organization. Types of risk faced by organization. It is FOX. FOX. Financial risk, operational risk, compliance risk, and strategic risk. Once again, financial risk, operational risk, compliance risk, and strategic risk. What is compliance risk? Unexpected changes in financial conditions. Unexpected changes in financial conditions. What is operational risk? Failure to cope with day-to-day operational problems. Failure to cope with day-to-day operational problems. What is compliance risk? Comply with rules and regulations or else will lead to penalties. Non-compliance will lead to penalties. Strategic risk. Company strategies become less effective so that and because of that it struggles to achieve goals. It struggles to achieve goals. Strategy becomes less effective so that, and it struggles to achieve its goals. In this chapter, risk management, we'll be studying only about the financial risk in detail. Only about the financial risk. Classification of financial risk. Classification of financial risk. Four things. Counterparty risk, political or country risk, interest rate risk, and currency risk. Counterparty risk, political risk, interest rate risk, and currency risk. These four now will be studying two things. In these four will be studying two things. That is assessment or identification, and methods or techniques, ways or techniques to mitigate those risks, like management, ways or techniques to mitigate those risks. Let's start with counterparty risk. Counterparty risk. Non-honoring of obligations by counterparty. Non-honoring of obligations by counterparty. It also covers credit risk. It also covers credit risk. Example. If you have given loan to someone and it doesn't repay the loan, so it is a risk. So that is counterparty risk. Non-honoring of obligations by counterparty. It also covers credit risk. Now, assessment or identification or hints or indication. Assessment or identification or hints or indication. Now we'll be using the picture memory. Picture memory. So look at these pictures carefully. Look at these pictures carefully. Third party, foreign government, resources insolvent, third party, foreign government resources insolvent, third party, foreign government resources insolvent. Okay. So, counterparty risk, third party, foreign government resources insolvent, third party, let down by third party, foreign government, hostile action by foreign government, regulatory restrictions from government. So from government there are two things, one is from foreign government and one is from government point of view. So foreign government, hostile action of foreign government. Hostile action is that aggressive action. So hostile action of foreign government. Regulatory restrictions from government. Resources. That is failure to obtain necessary resources to complete the transaction. Failure to obtain necessary resources to complete the transaction. Insolvent. Have become insolvent. So again, third party, foreign government resources insolvent. Third party, foreign government resources insolvent. So third party, let down by third party. Government from two things, that is foreign government. Hostile action by foreign government. Regulatory restrictions from government. Resources. Failure to obtain necessary resources to complete the transaction. Have become insolvent. Done. Next. Management or mitigation or techniques or ways. To manage the risk of counterparty risk. Okay. See now this one. Wrapper limits due to commitment. Wrapper limits due to commitment. So wrap. Rapid action. Rap is rapid action in event of default. Rap is rapid action. Rap is rapid action in event of defaults. Per. Per. Per is performance. Per is performance. So use of performance guarantee. Use of performance guarantee. Rap is rapid action in event of defaults. Per is use of performance guarantee. Use of performance guarantee. Limits. Limits. That is two limits. So limits. Due two limits. No, here two means there are two limits. That is know your exposure limits. Know your exposure limits and review credit limits regularly. Two limits, exposure limits and credit limits. Exposure limits, know your exposure limits. Know your exposure limits and credit limits is review credit limits regularly. Review credit limits regularly. Next, due. Due is due diligence. Due is due diligence. Carrying out due diligence before dealing with any third party. Carrying out due diligence before dealing with any third party. Commitment. Commitment. Do not overcommit. Do not overcommit. Do not overcommit. So again, we were studying about the counterparty risk. What is counterparty risk? Non-honoring of obligations by counterparty. Non-honoring of obligations by counterparty. It also covers credit risk. So what is the assessment, identification, hints or indications of counterparty risk? Third party foreign government resources insolvent. Third party foreign government resources insolvent. Third party let down by third party government. Government, that is hostile action by foreign government and regulatory restrictions from government. Resources, failure to obtain necessary resources to complete the transaction. Failure to obtain necessary resources to complete the transaction. Insolvent, have become insolvent. Management or mitigation or techniques or ways to manage counterparty risk. That is wrapper. Wrapper limits due to commitment. Wrapper limits due to commitment. Picture memory. Wrapper limits due to commitment. Wrap is rapid action. Rapid action in event of defaults. Per is performance. Use of performance guarantee. Use of performance guarantee. Due is due diligence. Due is due diligence. Due is due diligence. That is carrying out due diligence before dealing with any third party. And limits, there are two limits, that is exposure limits and credit limits. Exposure limits, know your exposure limits and review credit limits regularly. Commitment, do not overcommit. Do not overcommit. Next, political risk or country risk. Political risk or country risk. It is faced by overseas investor. It is faced by overseas investor. It is faced by overseas, not in that country, the other countries investor. So it is faced by overseas investor. Adverse action by government lead to huge losses. Adverse action of government lead to huge losses. Adverse action of government of host country, matlab this country's government, if it takes adverse action, it leads to huge losses to the overseas investors. So it is a political risk or country risk. It is faced by overseas investors. Adverse action by government of host country may lead to huge losses. Now, assessment or identification. In this also we are going to study two things in this. That is, political risk can be identified from following actions by government of host country. So what are the actions the government is doing? How can we identify those? Okay. So again, picture memory. So what is this? Seas. What are these? Seas. What is this? Home country. Home country. What is this? Currency conversion. Conversion of currency. And this is BP. Okay. BP. Now, so, political risk can be identified from following actions by government of host country. That is, seas means overseas. Seas is overseas. Home country. Conversion, currency, conversion of currency. B is borrowings, P is price. B is borrowings, P is price. Okay, so overseas. Confiscation of overseas properties. Home country. Remittance to home country. Rationing of remittance to home country. Restriction on conversion of currency. Restriction on conversion of currency. B is borrowings. Restriction as to borrowings. Restriction as to borrowings. P is price. Price control of products. Price control of products. So again, political risk can be identified from following actions by government of host country. C is home country, currency conversion and BP. Currency conversion and BP. So overseas. So overseas, that is confiscation of overseas properties, confiscation of overseas property, remittance to home country, rationing of remittance to home country, restriction on conversion of currency, restriction on conversion of currency, restriction as to borrowings, B is borrowings, restriction as to borrowings, P is price control of products, price control of products. Next, see, we finished identification. Now it is assess. Organization interested in making investment in foreign country can assess country risk. How can you assess country risk? Country risk. Assess country risk. See, country. R cap. R cap. That is rank. Rank we get a cap based on conditions. Rank we get a cap based on conditions. Conditions. Advisors and popularity. He becomes popular after that. He listens to the advisors and then he becomes popular. Popular. Okay. So ranking, conditions, advisors, popularity. Rank, conditions, advisors and popularity. So ranking, referring political ranking, referring political ranking, referring political ranking, conditions, evaluating macroeconomic conditions, evaluating macroeconomic conditions, advisors, taking advices from embassies, taking advices from embassies, and P is popularity. Analyzing popularity of current government, analyzing popularity of current government, analyzing popularity of current government. You can remember as ranker will get a cap, ranker will get a cap, cap is conditions, advisors and popularity, conditions based on advisors and popularity. Ranking, referring political ranking, evaluating macroeconomic conditions. A is advisors, taking advices from embassies, and popularity, analyzing popularity of current government. Next, management or mitigation of risk or ways of political or country risk. Management, how will you manage? Again, see, local negotiations to enter. See, country risk, no? How will you manage? You have to make local negotiation. If you're going to Germany, you have to negotiate by through German language. So, local negotiation to enter. Just to remember, okay. So, local negotiation to enter. Local negotiation to enter. Local negotiation to enter. So, local. So, here again, two words is there, no? So, means two words of local. So, local. Local sourcing of raw materials and labor, local financing. Local sourcing, local financing. Local sourcing, local financing. Negotiation. Prior negotiations. Prior negotiations. Enter. Entering in joint venture. Entering in joint venture. Done. Next. Interest rate risk. Interest rate risk. It occurs due to change in interest rate resulting in change in assets and liabilities. It occurs due to change in interest rate. Changing interest rate. Assessment or identification. Assessment or identification. Interest rate risk. Remember about demonetization. Remember about demonetization. That is, government demonetize money. That is money. Government demonetize money. Stock market investment growth. Stock market investment growth. So, any action by government such as demonetization. Assessment or identification. How will you identify interest rate risk? Any action by government such as demonetization. Monetary policy of government. Money is monetary policy of government. Stock market changes. Investment by foreign investors, and economic growth. So again, see, government demonetize money, stock market investment growth, stock market investment growth. Any action by government such as demonetization, monetary policy of government, stock market changes, investment by foreign investors, and economic growth. Management or mitigation are techniques or ways of interest to manage interest rate risk. Forward rate agreement, interest rate futures, options, swap. Whatever we studied in practical part no, of interest IRRM chapter, that it is. Forward rate agreement, interest rate futures, options and swaps. Next, currency risk. Currency risk. It mainly affects the organization dealing with foreign exchange as their cash flow changes with movement in currency exchange rates. Currency risk. It mainly affects the organization dealing with foreign exchange. Currency risk is foreign exchange, as the cash flow changes with movement in currency exchange rates. Okay. What are the assessment or identification of parameters? What are the assessment, identification of parameters? See, currency risk. In CA Inter, we didn't have the forex chapter, so there was no risk of currency. So in CA Inter Nare, we didn't have for currency risk, that is forex chapter. So CA Inter Nare, CA Inter Nare, Na is nahi. Okay, so CA Inter Nare. C is change of government. A is government action. C is change of government. A is government action. Inter is nominal interest rate. Nominal interest rate, inflation rate. Nominal interest rate, no, inflation rate. Na is natural calamities. Re is rebellion. Re is rebellion. So CA inter na re. That is the currency risk. In CA inter we didn't have forex chapter. So just to link. So CA inter na re. So C is change of government. A is government action. I inter is nominal interest rate, inflation rate. Nare is natural calamities and rebellion. That is war, coup, rebellion, etc. Next, management or mitigation or techniques or ways of currency risk. How do you manage currency risk? Money market hedging, currency options, forward contract, make invoice in home currency. Make invoice in home currency. Money market hedging, currency options, forward contract, make invoice in home currency. These are the practical topics what we studied in forex chapter. Okay. Next, evaluation. Now we are done with those four risks. That is counterparty risk, political or country risk, interest rate risk, and currency risk. Now next topic, evaluation of financial risk. Evaluation of financial risk from three point of view. That is stakeholders, companies, and government. Stakeholders, companies, and government. Stakeholders point of view, financial risk we evaluate from financial gearing. That is capital gearing. More the risk, more debt, more risk. More debt, more risk. So financial gearing. From company's point of view, borrows excessively. That is more debt, then financial risk is more. Borrows, if the company borrows excessively from debt, then it can be forced to go into liquidation. It can be forced to go into liquidation. So borrows excessively, then that will be the risk, financial risk. From government's point of view, failure of any bank. Financial risk can be viewed as failure of any bank. Failure of any bank. Last and important topic, that is value at risk. Value at risk, that is VAR. VAR, value at risk. What is it meaning? How much an investment might lose in normal market conditions. How much an investment might lose in normal market conditions. For example, if I invest 1 lakh in normal conditions, how much is the loss? How much is the loss in in normal market conditions? So it is a measure of risk of investment. It is a measure of risk of investment. How much an investment might lose in normal market conditions. In normal market conditions. So what are the features? What are the features of value at risk? What are the features of value at risk? PQRSTZ. 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 Okay. So P is probability. P is probability. P is probability. R is risk control. Risk control. S is statistical method. Statistical method. T is time horizon. T is time horizon. And Z is Z score. Probability, risk control, statistical method, time horizon, and Z score. Q there is nothing, it is components. Q is components. That is LLP. That is LLP. That is LLP. That is level, loss, and period. Level, loss, period. LLP is what? Level, loss, and period. So confidence level, that is 95 and 99% generally. Then loss in percentage or in amount, and time period. So PQRST. PQRST Z. Z is Z score, T is time horizon, S is statistical method, R is risk control, P is probability, and Q is components. That is LLP. That is level, loss, and period. Level, loss, and period. So probability. Probability of maximum loss can be predicted. Probability of maximum loss. Risk. Risk control by setting limits for maximum loss. Risk control by setting limits. Statistical method is based on standard deviation. Based on standard deviation. Time horizon, that is 1 day, 1 week, 1 month. For what period you are calculating. Z score indicates how much standard deviation is away from the mean value. How much standard deviation is away from the mean value. How much standard deviation is away from the mean value. Components, confidence level, loss in percentage and time period. Next, applications or significance. Applications or significance of VAR. Applications or significance of VAR, that is value at risk. Okay. So, tool to measure benchmark, to fix limits, to decide trading strategies. What is VAR? It is a tool. It is a tool to measure. It is a tool to measure benchmark, to fix limits, to decide trading strategies. It is a tool to measure benchmark, to fix limits, to decide trading strategies. Whatever is the box, read it. Read it along. You can make it. You can frame a sentence. Okay. It is a tool to measure, benchmark, to fix limits, to decide trading strategies. As a tool for asset and liability management. As a what is applications is as a tool for asset and liability management. Asset and liability management to measure maximum possible loss. To measure maximum possible loss as a benchmark for performance measurement. As a benchmark for performance measurement. To fix limits. To fix limits dealing in treasury department to fix limits for individuals dealing in treasury department to enable the management to decide trading strategies so what are the applications or significance? Tool to measure benchmark, to fix limits, to decide trading strategies. Thank you so much guys. I hope you enjoyed the lecture. Stay tuned for the other chapters.